I think there's more left. I mean, we probably picked up about a month ago that the UK was breaking out, and last time I was on, I described this sort of rotation out of long duration into old economy, and I think some of that is, the nature of the UK index, which is heavy on the miners, the oil companies, some old school names. Consumer discretionary has done really well as well, and so you're seeing the benefits of that coming through in the index. And ultimately, I think one of the things that stood out for the UK was it was cheap compared to a lot of the other indices around the world. And so I think that as an inflation hedge, and we can come and talk about this in terms of where we've seen money flows, cheap valuations is a way of protecting yourself effectively. So I think you're seeing that rotation. The numbers you're seeing this morning in terms of continued pressure on inflation data suggest that that's got a little bit further to run. But if you're looking, so I think the challenge is that what you want to do for this year might be very, very different to actually what you want to do for next year. So I think you're going to start to see people rotate out probably in the sort of midpoint of this year, and I think there's a different kind of stock that you'll look to see the market play.
Well, let's wait until we get midway through the year and we'll see you again and we'll ask you about it then. But what do you do right now? Because I think the problem is that you see the stronger retail sales number in the UK this morning and you think, well, actually, maybe the Bank of England is finding more reasons to give us another 25 and then another 25 after that. Yeah. And what ultimately does that imply in terms of the ability of these UK markets to grind higher?
So I think that people are going to continue focusing on attractive valuations, cash flows, and yields, and so I don't think we're going to see near term any sort of change to the rotation pattern that we're seeing. So people, you will see people buying into, the BPs, etc., the energy hedges for the near term, I think. Interesting, I think there's that, where you're starting to see a shift. I know that the banks, and you've seen it in NatWest's number, come off today, but they're starting to look really attractive. And I think, again, from a valuation perspective, European banks in particular are starting to look quite attractive, UK banks included in that mix. As rates go up, you will be able to see improved profitability.
Karen's going to come in, but you've already had 10% out of the Euro Stoxx 600 bank subsector. Yeah. You think there's plenty more to come?
I do, because the classic mistake people make is that they have a look at, okay, well, let's take a look at near-term history. And I think you've got to remember that near-term history, probably for the last 20 years, has been a little bit of an aberration. We haven't had this kind of environment, or I don't think we're in what is a normal environment if you look at near-term history. So you're going to move back to, regular, real interest rates. And those banks, I think, are in incredibly strong positions this time. So post-financial crisis, there was quite a lot of constraint, effectively, in terms of where they could lend. So the main concern as you move into a tougher economic environment is credit risk, right? We're going to see defaults, etc. But actually, I think they've been very, very careful about how they've been lending. In some instances, they just haven't been able to lend. And as you start to see rates starting to move up, I think that their different profitability streams start to open up for them.